This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 311 was recorded on February 17th, 2022. I'm Erik Townsend. This episode is brought to you by Abaxx Technologies, pioneering the design of smarter markets that better serve the needs of both market participants and society as a whole. And by Masterworks, the billion-dollar alternative investment platform that lets you invest in art by legends like Warhol and Picasso for a fraction of the cost. Bianco Research founder Jim Bianco returns as this week's feature interview guest. Jim and I will discuss everything from inflation to bond yields to the equity market outlook, and we'll even touch on what the decentralized finance revolution might mean to fixed income markets in years to come. Then be sure to stay tuned for our post-game segment when Patrick's chart deck is titled, Is There More Downside for Markets?
And I'm Patrick Ceresna. Erik, let's jump into that S&P 500. Obviously, the last week saw a lot of geopolitical news between Russia and Ukraine, whipping the markets higher and lower. But generally, the market is pretty weak. It seems every rally is failing, and we're sitting down very close to the 4,400 level at the time of recording. What's your take on the markets?
Patrick, I think the extremely unusual geopolitical backdrop is really important to understand. And here's the way I see it. I think we have a divided society in general, but that also means divided market participants in terms of everyone's personal political biases. There are two views here, or two extremes, I should say. There's a view that says, look, we know that the White House has told us that the United States government is in possession of credible intelligence that says Russia is preparing to do some really nasty stuff, false flag invasions and just really bad stuff in Ukraine. And this is all imminent. It's nearly certain to happen. Boy, just watch out. Meanwhile, there's an opposing view where some people feel like, hey, wait a minute, the White House has presented exactly zero evidence to support this contention that supposedly Russia is up to all of these bad things, and they're starting to question the White House's credibility rather than the Russians' credibility. What that sets up, and to be sure, I'm not taking sides in this fight, and MacroVoices is about markets, not politics, but the point that I want to impress upon our listeners is that what this does is it creates a situation where the exact same news event will be interpreted completely differently by market participants, including well-trained professional institutional traders who normally interpret the news in the same way, and they're racing to put the same trade on. Now you're going to have two guys with different personal political biases interpreting the same exact event in the opposite way. Perfect example of this. One of the things that happened this week is President Zelensky, who used to be a stand-up comic, cracked a sarcastic joke saying, well, I'm told the date of the invasion is tomorrow, Wednesday the 16th. He said this on Tuesday. Well, some people took that in the literal sense of, oh my gosh, Zelensky has confirmed that's it. It's all happening. It's guaranteed. It's all disaster. Other people with the opposite political orientation said, no, he was being sarcastic and he was actually mocking the Biden administration for making all of these proclamations without evidence. Well, if people are going to interpret the same event with opposite meanings, that's just a setup for tremendous amounts of market volatility and uncertainty. Another example, just last night, overnight, there were shellings that destroyed a kindergarten schoolroom somewhere in Ukraine. So that leads to some people saying, okay, look, this is proof that the White House was right. Surely this must be Russians setting up a false flag in order to start a war with Ukraine. Meanwhile, other people are saying, no, it's not proof of that. It's the exact opposite. It is proof that all of this Russian nonsense was never true. And I actually saw one guy on Twitter suggest that it's the CIA that is doing some kind of false flag because the United States has economic benefit to derive from fomenting the outcome of war between Russia and Ukraine. So again, I'm not taking sides. The point is expect plenty of volatility and misplaced signals as this situation in Ukraine evolves. Moving on, It's really important to take a big step back from this and say, wait a minute, all of this that's been going on, it's all about when you get a signal that looks like a war is coming, oh boy, sell everything. Stock market goes down. When it looks like maybe there's no war, stock market goes up. Hang on, take a big step back and look at history. What we know about wars is the same thing almost always happens. It happened 9/11, it happened the Gulf Wars. When there's a war, everybody panics and says, oh my God, there's a war. Quick, sell everything. Panic. Oh my gosh, sell it, sell. Hey, wait a minute. A few weeks later, they say, oh yeah, when there's a war, it's almost always inflationary, and it creates an additional demand both for military purchases of goods and services, and generally it tends to be good for the stock market. So we got backward signals both in the short-term time frame and the medium-term time frame, and it's all creating to a tremendous amount of uncertainty. And then you've got to overlay on top of all of that. Okay, so what does that mean? If wars, even if it does happen, usually are bullish for the stock market in the long run, although they typically involve a panic spike down at first. Well, wait a minute. We've still got the backdrop of Fed policy. And we just had Zoltan Pozsar, the very well-respected Credit Suisse analyst, come out and say that Jay Powell almost has to do something in order to force asset prices lower. So there's just so many complex signals on top of one another. I don't think you can figure it out, but I really think it's important to realize that personal political biases are going to dramatically skew the way people interpret the news events, and I think it's going to lead to lots of volatility.
Well, let's move on to the dollar, because what I find particularly interesting is that the dollar really hasn't been that volatile in all of this. Like, while the markets and crude oil and everything are moving, but the dollar's been more or less pinned around 96. Do you think the dollar can still make a bigger move on all of this geopolitics?
Well, great minds think alike. When I saw almost no change as I pulled up my dollar chart today, I thought, did I forget to roll the contract forward? Has it expired? What's going on here? We're just consolidating around 96. I'm watching closely for signals. I don't have any directional view, but as you say, I think that we should be watching closely to see what signal the dollar gives us about where the Fed is headed and the geopolitics and everything else. It's, again, going to be interesting if, let's say the dollar moves up sharply. Is that a reaction to monetary policy? Or is that a reaction to geopolitical events? It's really hard to say, especially when different people interpret the same geopolitical event to have opposite meanings.
Well, let's move on to crude oil. We obviously, all these geopolitics have driven huge volatility. We had a breakout in crude punching 94, 95, depending on which contract you're looking at. Gave much of it back, and surprisingly, we were about the same price level we were when we recorded last week, but a lot of volatility along the way. What do you think is going to happen here in crude?
Well, I think there's lots more volatility still to come. Let's start with EIA inventory. Crude oil building 1.1 million barrels, although there was a drawdown on the Strategic Petroleum Reserve of 2.7 million barrels. Cushing, Oklahoma, drawing down 1.9 million barrels. Cushing inventory getting just dangerously low. Gasoline drawing down 1.3 million barrels. Distillates drawing down 1.6 million barrels. So almost 3 million barrels of drawdowns in finished products, offsetting the much smaller build of 1.1 million barrels of crude oil. U.S. production stayed flat at 11.6 million barrels. As you say, Patrick, it's been a roller coaster week in the oil market. Russia-Ukraine has been the dominant theme, but then Wednesday afternoon, after the pit close, somebody close to the Iran nuclear negotiations tweeted something saying, okay, we're as close as we've ever been to coming to a deal here. Now, that again causes different traders to come to different conclusions. The simplest interpretation is, wait a minute, if we came to a deal with Iran, that could put all of Iranian production back on the market. Maybe that's another 3 million plus barrels per day of oil hitting the market, and that would certainly do a lot to alleviate these elevated prices and fears of running out of stocks and inventory and so forth. But hold on. A lot of people think that Iran has been quietly selling a lot of their oil on the black market all along. And, there's a difference when you start to put that black market oil onto the open market. But at the end of the day, if China was quietly buying that oil on the black market, China's going to have to buy it on the open market. It doesn't really change the supply and demand dynamics by nearly as much as it would first seem. Which of those views is right? To what extent, how much of Iran's oil has been sold on the black market? I don't know. There's no chart for that. So it's anybody's guess. I don't think it's really easy to interpret what that means, or it's certainly beyond my pay grade. As far as where we're going from here, if we had a combination of an Iran deal and no invasion between Russia and Ukraine and no geopolitical escalation there, those two things together could spell a very deep correction, maybe $10 down. I don't know. But I still say $100 plus by summer. I think that all of the fundamental supply and demand drivers are there. And the other thing I notice is that even with the fairly dramatic sell-off that we've seen in the last few days, coming down from almost $96 to 91.22 as we're speaking, just a hair over the 13-day moving average, which is the lowest of the three short-term moving averages. We're really kind of at a low swing point here, or at least, who knows, maybe it goes quite a bit lower. Even at this sort of low point in price, I'm still looking at the front of curve time spreads north of $1.80 per month between April, May, and May, June. So that says that there's a lot of fear of just not having enough physical oil in the market to deliver in coming months. So the shortage of physical supply in U.S. inventory is very real, as evidenced by those time spreads. So what I'm kind of looking at here is, depending on how the geopolitics go, and that's both the Russia-Ukraine situation as well as the Iran situation, depending on how those go, there's probably some kind of correction coming. How deep of a correction will depend on how those things go. But then I think that the reality kind of comes back into the market, which is we don't have enough oil. We still don't have enough oil. And Iran is not going to change it overnight. It might change it longer term, but certainly the crunch that we're going to have into summer is still upon us. So I still say $100 plus by summer. I wouldn't be at all surprised if we broke $147, which was the previous all-time high back to 2008, by the end of 2022. But that's not a prediction. There's too many factors in play there in order to predict that outcome. I'm just saying it's the first time I've really felt like it's a real possibility.
All right. Well, let's move on to gold. I have a chart for this in the post game, but it's a pretty good breakout here. Is it going to stick this time?
Well, finally, this chart is really starting to look fantastic. Breakout above channel resistance, and then we got above 1860, which was that key level that we were eyeing for resistance, and we got above 1880, which was the previous high from November. All of these things really spell big breakout, the beginning of some great big move higher. But hang on, wait a minute. This all happened in the back of Russia-Ukraine tensions. And if you look at the tape action, it's very clear that the big spikes up have been reactions to Russia-Ukraine news events. That could be a setup for a full retrace lower if there is no invasion and nothing ever really happens between Russia and Ukraine. But hang on. Crude oil retraced, even before the Iran news came out, crude oil retraced a lot of its big gains on that geopolitical news, but gold really didn't, and gold has stayed well above that 1860 level. So as long as we stay above 1860, I'm cautiously very optimistic that even if the geopolitical situation doesn't last, well, that would certainly result in a pullback. But I think we may still have already seen the catalyst needed to get this market going from a technical standpoint and to start to propel us higher. On the other hand, how many times have we said that and only seen the market retrace lower? So I'm keeping my fingers crossed. But as long as we stay above 1860, feels pretty good. As far as targets higher from here, 1920 would be the next big target above 1880, which we're already above. We're at 1900 as we're speaking now. 1920 was the high from May of 21. 1962 was the high from November of 2020 and again in January of 21. And then 2089 was the all-time high going back to August of 2020. If we get above that, that really says the bull market is on.
All right. Well, let's touch on the 10-year Treasury yield. We're still more or less a stone's throw around 2%. What's in store for the bond market?
Well, I think, as you say, we broke 2% on the day we recorded last week's podcast. It's a week later, and although we certainly have dipped below 2%, we're back up to it, or we were this morning. I think we're back below it right now. Jim Bianco is the fixed income guy, so I don't want to steal his thunder. But my feeling here is it's beyond my pay grade. That's why we got guys like Jim on the show, and I think it's a very important time to not take your eye off the ball. You got to watch carefully and see what this market's going to tell us. Let's find out what Jim, who has a lot more experience in fixed income, thinks in the feature interview.
Well, this week's feature interview guest is Bianco Research founder Jim Bianco. Erik, why did we invite Jim back on the show this week?
Well, our regular listeners already know the answer. As I said last week, my favorite two macro fixed income gurus are Alex Gurevich and Jim Bianco. So those are the two guys that we had last week and this week. Really looking forward to this interview with Jim, and I think you're going to enjoy it too.
Well, Erik's interview with Jim is coming up as Macro Voices continues right after this message from our sponsor.
Abex Technologies invites you to Smarter Markets' new podcast series, Demystifying Carbon Markets. Corporate climate pledges went mainstream in 2021. Moving into 2022, these companies are increasingly focused on developing and implementing plans to turn their climate pledges into climate action and understanding how carbon markets can help them turn their good intentions into meaningful change. For many, however, carbon markets remain unfamiliar, creating apprehension over potential risks. They have many questions. What are carbon markets? What types of projects help reduce carbon emissions? How do I judge the quality of these projects? Will the carbon markets be large enough to meet net zero goals? In this series, Smarter Markets teams up with Base Carbon Corporation to bring you the architects and practitioners of the carbon markets, seeking answers to all of these questions from people who know the markets best. Episodes are available weekly on Saturdays beginning February 5th.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Bianco Research founder Jim Bianco. Jim, it is great to get you back on the program. It's been so long. I want to start with the subject that I know is near and dear to your heart and mine, which is, this whole big picture of inflation and the credit market and what's going on with fixed income. And here we are, 2% on the 10-year yield. Some people say this is the beginning of the end. The bond market's about to crash. Alex Gurevich told us last week, no, it's actually time to buy bonds, not to sell bonds. And there's something kind of fascinating to me, which is I've seen this narrative floating around where people are saying, hey, wait a minute. If you look at what's going on with the stock market's reaction to inflation, you kind of think that inflation is not transitory and about to run away. But if you look at the credit market's reaction to inflation, it looks like the credit market is not really persuaded that this is going to be non-transitory secular inflation. Is that right? And a lot of people think the credit market's smarter than the stock market. What's going on here?
Yeah, so a couple of things. Let me start at the beginning of your question about inflation. So obviously everybody knows that we've got a 7.5% inflation rate and it's a 40-year high. We also know from the inflation statistics, given where we saw the numbers in March, April, May, June of last year, 0.6, 0.9, 0.6, that unless we continue to put up 0.6, 0.9, we'll probably have a peak in the year-over-year numbers. Now, that's not a sign that inflation is over, because I think the story in the second half of the year is going to be that how fast does inflation descend, and count me in the camp that is not very fast, and that we're going to still wind up with a very elevated number. But why do we have inflation? I'm going to give you a little different answer as to why we're going to have inflation. Every generation has a financial event. This generation's financial event was we sent everybody home for a year. Last generation's was the great financial crisis. The one before that was the tech bust of 2000. Because we sent everybody home for a year, I think what we're not appreciating is a lot of secular changes have occurred in work patterns, purchase patterns, and in the general economy. Now, do not mistake that for saying that it's dystopian. It doesn't have to be dystopian, and I don't think it is necessarily bad. And what I mean by that is we went home for a year. We showed work from home is a viable alternative, or remote work is a viable alternative. And for a lot of people, it's preferred. And we're having a very difficult time getting people to go back to the office. In fact, there's stories even this week, HSBC being the latest, that they're raising banker pay a lot, because one of the things that New York City banks want is they want you in the office 5 or 6 days a week, 10 hours a day. So they have to bribe you to do that, because a lot of people don't want to do that anymore. And because we're working at home, our consumption patterns have changed a lot. We need more stuff as opposed to services, because we're now remote. And that is leading to a general confusion among shippers and manufacturers What am I supposed to make? What am I supposed to ship? I have the schedule of what it used to be in 2019, but that doesn't seem to work anymore. Obviously, the 2020-21 schedules were lockdown schedules of what people wanted. I don't assume that's going to work. I don't know what they want, so I order everything. And that's why we have this perpetual supply chain problem as well, too. And the reason I bring that up is because it seems like a lot of economists like to say, as far as the inflation problem is a supply chain problem. Yes, that's true. So therefore, do nothing. Just stand there and wait, and the supply chain will resolve itself. No, it won't. It won't until we have an introspection of what does the post-pandemic economy look like? And I think the answer is it doesn't look like 2019. And so the sooner we understand that, the better we can go about starting to understand what this new economy is. In the meantime, inflation is going to stay elevated. There's a friction in the economy, a mismatch. There's a friction with supply. And we've also overstimulated the economy with too much stimulus checks and too much fiscal stimulus as well, too. So that's why I think that the inflation rate is going to stay up. As far as bonds go, let me be clear that in this environment, you have to separate short-term rates and long-term rates. Let me start with short-term rates. Short-term rates are going up. The 2-year note in the United States was 22 basis points in September. It's 160 basis points now, 5 months later. The bond market is pricing in something like 6 or 7 rate hikes as we go forward from here. And this has brought up an interesting disconnect. The bond market thinks 6 or 7 rate hikes. But if you ask most fund managers, the Fed's not going to go that far. Fed's not going to do that much. And the reason that you hear that, as far as people saying the Fed's not going to go that far, you go, well, wait a minute. If the market's pricing in 6 rate hikes, isn't what the market prices in the consensus? But the consensus seems to be something less. Because the people that price in those 6 rate hikes are T-bill traders, Eurodollar traders, repo traders. They're very, very close to the Fed. They think the Fed's going to be more aggressive. Equity traders, long-term bond traders, international global fund managers that are not as close to the Fed, they think something else. And what this is it's about a priority. From 2000, actually I could go from 1980, but I'll go 2008 as well too, when they started modern QE, to the beginning of last year. The priority of the Federal Reserve was growth. It was to make sure that the economy grew as fast as it could. And to that end, they had this thing called the new framework that they introduced in September of 2020, where they were going to put an emphasis on trying to keep employment as high as possible, even if it meant letting inflation run hotter than usual. The growth priority also shows up in what is known as the Fed put. The Fed will never let the stock market fall too much because it creates a reverse wealth effect. But now I would argue that the priority of the Fed is shifting to inflation because of the big 7.5% number, the persistence of inflation as well too. And it's going to stay there. And those that think, no, the Fed will move less, because it doesn't want to impair growth, it won't impair the economy, are going to find out that that might not be the priority of the Fed anymore. The last thing you mentioned was about the credit markets. Let me make a quick comment. Credit spreads have widened. They just haven't widened as much as you would have thought given the volatility in the equity market. So first thing is they have widened. They have shown some concern. Now, part of that could be the various mix of what you have in the credit markets. Energy companies tend to be bigger borrowers, so their weighting in the high yield index or in the investment grade index is higher than their weighting is in say the S&P 500. So with booming oil prices and booming energy prices, they're perceived to be better credits, and so their bonds are not widening as much as everything else. And with a higher weighting, you'll see them relatively perform a little bit better. But there's another dynamic that's going on in the credit markets, which I think a lot of people don't realize is occurring. No one sells anymore in the credit markets. It's either you buy or you hedge, or you buy or you hedge. What has happened since January is two things. If you look at puts on the HYG and the LQD indexes, these are the high yield ETF and the investment grade ETF, the iShares ETFs. Puts have exploded in volume and open interest since the market started getting a little messy around January 1st. Credit default swap volume has exploded higher. ETF volume has exploded higher. ETF volumes right now, if you look at dollar volumes of the HYG and all the junk indexes that trade, it's 80% the volume of the underlying cash market. No other ETF sector, whether you're talking gold, healthcare, international, whatever you want, nothing is approaching what is happening in the high yield and in the investment grade ETFs, that they trade almost as much as the underlying market. By the way, speaking of the underlying market, cash market volumes of high yield bonds and investment grade bonds that trade 8-year low. They're not trading the bonds. You buy bonds when you're bullish, you buy puts and you short ETFs, and you buy credit default swaps when you think things are going messy. So there's an old adage in the stock market. It's a market of stocks, not a stock market. I think that really applies for the bond market. It's a market of bonds. It's not a high yield market, but we trade this like it's a high yield market. We just, buy the ETF, buy puts, buy credit default swaps or not. Wait a minute. Casino bonds are not the same as energy bonds, which are not the same as healthcare bonds, even more than casino stocks, energy stocks, and healthcare stocks. But that's the way that we seem to trade it right now. And that's one of the things that might be masking the sell-off that you see, or the lack of urgency in the credit markets, is it trades as one instrument. And when that one instrument decides that now's the time to sell, which it hasn't for many, many years, because it either is buy or hedge, you could have real problems moving forward with the market. And last thought on this for you. Why is it that why is it bigger now than it was before? I think this is an echo of the 2020 response to the pandemic. Remember, in the pandemic response, the Fed came in and created facilities to buy investment grade bonds and buy high yield ETFs as well too. And there was a mantra that went around Wall Street: buy credit because you're co-investing with the Fed. As long as the guy with the printing press is buying the same thing you want to buy or refuses to let what you're buying go down, I want to be long it. Okay, the Fed's not buying high yield ETFs or investment grade bonds today, but there is a belief that if the markets wobble enough, the printing press will come back and make sure that everything's okay. So just hedge, don't sell. If I'm right about the priority shifting and a realization comes in that the printing press, the Fed, is not going to show up and start buying investment grade bonds if they start performing sloppily because they've got a different priority, then I think you're going to see a whole different type of credit market. So I'd say with the credit market sell-off, to be continued, because all they're doing is hedging and they're waiting for the storm to pass.
Wow, so much to unpack there, Jim. Let's go back to one of the first things you said, which was this trend, and I've heard it framed the same way you framed it by other people. They're saying, boy, there's going to be this kind of showdown between employers and employees because the employees are going to want to continue working at home and not have to go back to the office. The employers are not going to want to hear that. I feel like I'm missing something. Manhattan office space is super expensive. If we've learned how to work remotely, and it seems to be working for most businesses, especially in finance, where maybe people have to get a couple of extra computer monitors at home, but they seem to be able to do it. Why would the employers not want to save money on office space and just let everybody work at home? Why wouldn't that just become the new trend?
Well, let's start off with that. Just to put some numbers on this, about a third to maybe as many as half of the employees in the United States can work from home. So we're not talking about everybody, right? The great examples I like to use is a surgeon can't work from Zoom, and a waitress can't work from Zoom, and a policeman can't work from Zoom, and many other jobs like that is too. But about a third to about a half of the jobs. So of those third to half of those jobs, you're right, a lot of them fall into financial services. So why aren't they all excited about the idea to save a ton of money? Because not only do you save money in real estate, you also save money on support. Because one of the things that happens when you work from home is you're responsible to, support your own technology. If your computer breaks, you have to fix it. They don't send the IT guy to your house. It's your problem if it gets fixed. So you save them a lot of money on that as well too. I think the simple answer is, who is the office designed for and who likes the office the most? The office is designed for executives. And, it is their office, managing director types, senior vice president types. They prefer the office more than anybody else. Who are 75% of the employees, roughly speaking, in a service sector office that can work from home? They're administrative, they're operational, they're maybe clerical as well too. The office is not designed for them. They're the ones that have to take the New Jersey Transit through the Port Authority. That is not a fun thing to do even through this day. They would prefer to work from home. So that's kind of the push-pull. Yes, Dave Solomon of Goldman Sachs wants everybody at Goldman Sachs back in the office 10, 11 hours a day, 5 or 6 days a week, because the office is a wonderful place, according to Dave Solomon. And he's right. For Dave Solomon, it is. But for the clerical staff, the operations staff, the administrative staff, they might have a different view about 200 West Street, which is the headquarters of Goldman Sachs as well. So I think that's kind of the push-pull. The other thing is a lot of Manhattan office real estate has been signed to very long-term leases. JP Morgan, Jamie Dimon wants everybody back in the office. Why? He just spent over $1 billion building the JP Morgan office tower. He's got a lease that is probably going to go forever, if not a generation. So he just can't say, oh, great, everybody's going to go home. Let's just get rid of the office tower. Nope, it's yours. You own it now as well. And you are going to fill it with everybody that you have because you've spent years building this building. So the boomer managers aren't ready to make that shift, but the millennial and Gen X staff, that's operation clerical and stuff, is ready to make that shift. And that's where the friction is. That's why, like I said to you, I don't think it's a coincidence that at the same time you're having this friction and that they want everybody back in the office, you keep seeing stories all the time that they're raising banker pay to record numbers. They have to. That's the only way to get them to want to get on the New Jersey Transit and go through the Port Authority every day to come to an office. They would prefer to work remotely. And then when they work remotely, they probably prefer to move out of New Jersey as well too. But if you don't let them work remotely, they can't move out of New Jersey as well.
Jim, I want to ask you about the Fed and whether or not they're making a policy error. But first, let's start with what's going on with the Fed, because there's this story I don't really understand. Who the heck is Sarah Bloom Raskin? I know that she's one of the Fed governors, but one of the less well-known ones. Why is she suddenly in the news? What's happening here?
She was a Fed governor, and now they're trying to bring her back as the vice chairman of supervision at the Federal Reserve. In 2018, there was a fintech company called Reserve Trust. And Reserve Trust applied to the Federal Reserve in order to get a license to use the Fed's master account. Now, in English, what that means is this fintech company was going to be able to transfer money in the financial system without using a bank intermediary. They were denied. They then put Sarah Bloom Raskin on their board, a former Fed governor. She made some phone calls to the Kansas City Federal Reserve, and the Kansas City Federal Reserve, all of a sudden, within a year later, the Reserve Trust got their license to have access to the Fed master account. And to this day, they still advertise that they're the only fintech firm that has that. So they can transfer money by cutting out the intermediary of a traditional commercial bank. She then resigned from the board, and they bought back her stock for $1.5 million. Now, I don't believe she did anything illegal in any of those activities. But two things. From the smell test, it doesn't look very good, especially if you're being promoted or being nominated to be the head of supervision, not just any old Fed governor. Second of all, I believe Reserve Trust was headquartered in Denver, which is why the Kansas City Fed was involved in it. Because of Wyoming's forward thinking about recognizing DAOs as a legal entity, there's a number of crypto banks headquartered out of Wyoming that want to also get access to the Fed master account, which would have to go through the Kansas City Fed as well too. They're not having any of that. They don't want any of these crypto banks to have master account status. So Cynthia Lummis, the Wyoming senator, has been really hammering away. Why do they get a master account? Because they hired you to put on the board, but then these Wyoming banks that are crypto-based cannot get that. So the Fed's in a very difficult position. Now, the Republicans are ganging up on her, and they're not allowing, as of this recording, a vote in the Senate Finance Committee on the 5 nominations that the Biden administration has put up, which includes Jay Powell to have a second term as Federal Reserve Chairman, and it includes Lael Brainerd to be the Vice Chairman of the Fed. So in essence, they're holding all of this up. Now, we'll have to see, maybe by the time this recording comes out, whether or not Sherrod Brown, the Democrat head of the Finance Committee, decides to separate Raskin and say, okay, well, we'll just vote on the other 4 because they're not as controversial. If he does that, she's effectively dead. They'll never vote on her, and that'll be the end of her as well. And so we'll have to see, but it is holding this up. And Erik, this brings up another issue as well, too. Wait a minute. January 31st, that was the end of Powell's term. It's mid-February as we record. Why is he still Federal Reserve Chairman if they have not voted on him again? Well, first of all, Federal Reserve rules say that if the next guy to be the Fed Chairman is not been approved by the Senate, the old guy continues in the seat until they get around to voting in the next guy. Well, in this case, the next guy is also Jay Powell. The old guy is Jay Powell. So the Senate didn't see an urgency to kind of get it. So they let his technically lapse and let him stay in there until they vote on him. But here's the problem. I mentioned a second ago that there's a priority among the Fed maybe of switching to inflation. We also know that inflation is the number one issue in the country, according to political polling. It is not crime. It is not COVID. It is not foreign policy like Russia. It is not climate change. It is inflation is the number one issue in the country. President of the United States has on many occasions, including earlier in the week we're talking, that the Federal Reserve has a plan to rein in inflation. So he said to the American public, yeah, I know you're very upset about inflation. There's this guy named Jay, and he works in this marble building over here in Washington called the Federal Reserve. He's going to fix it for you. And so the Fed is under enormous political pressure to do something about inflation. And oh, by the way, it wasn't their plan, but effectively the Senate is sitting on a veto of the Fed, so that Jay, fix inflation. Jay, if you don't fix inflation by, say, mid-year, well, we could just march down to the floor of the Senate and we don't have 50 votes for your renomination, and we'll throw you out and we'll find somebody else. Now, again, I don't think that was the plan all along, and I don't even think they think that right now, but effectively that's what's happened, is that he is the Federal Reserve Chairman. He is being asked to rein in inflation for the first time in 40 years, and the Senate is holding the sword of Damocles over him. And at any point he displeasures the Senate, they just won't have 50 votes for him, and he's out. So the Fed is in a position of enormous pressure, of loss of independence that I don't think we've ever seen right now with the Federal Reserve. And we'll have to see how it plays out. And what I'm suggesting is it's all about inflation and it's all about politics. And that's what Sarah Bloom Blaskin's about. And that's what this whole thing is about, is it's about politics. The Fed is it is one of the most political, the Fed likes to say that they're non-political. That is probably as not true as at any point in at least a generation. The Fed is intensely political and it revolves around inflation.
Jim, just summarizing that, your position is that the Fed's independence has been compromised, at least to some extent. Well, that's a perfect setup for my next question, because if you look back to the end of January when the FOMC meeting occurred and we had that nosedive in markets, well, wait a minute. Some people said that can only mean one thing. It's got to be that the market is telling us that the Fed has just signaled a serious policy error. They screwed up by being too hawkish, too aggressive. It's clear that their intention is to be very aggressive in raising rates. That's going to crash the economy, lead to a recession, and the stock market is, of course, a leading indicator of recessions. It means what's coming is a recession. Now, I think there's another argument, which is maybe the Fed is doing the right thing in terms of responding as they need to inflation, and perhaps it's not so much of a policy error. What is it? Is it a policy error? And if it is a policy error, how long does that policy error continue? In other words, if it does continue to crash the stock market, how far do we go before, from what you're saying, if their independence is compromised, before somebody whispers in Jay Powell's ear and says, if you want to be around next week, you better do this next, whether it's what you want to do or not?
I think it really comes down to the belief about inflation. And there is a strong belief in the financial markets among fund managers and traders and economists, those that care about this, that it's still somewhat transitory, that it will peak in the spring. I agree. It'll peak in the spring. And that it will rapidly decelerate down to around 2.5% or 3% by the end of the year. I disagree. I think that with the strong housing market, with the inability to, as I explained before, the inability to understand the shift in the economy, that the supply chain problem has been lingering and is still an issue, that the descent of inflation will be much slower and will stay at unacceptably high levels. So that's where the debate comes in as well. But I also think that the Fed has already made a policy error. They have another thing that the Fed likes to do, which is called forward guidance. And in English, what that means is the Fed wants to tell you 16 times what they're going to do before they do it. This inflation thing that, remember, 1 year ago, inflation was 1.5%. Today, it's 7.5%. It moved up on them too fast. They initially put in their framework for their new framework to emphasize employment, dismiss inflation fears, call them transitory, say it was going to go away. Because remember, the original forecast of the Fed was inflation was going to peak in the spring of last year and come down. And when that was when it was at an unacceptably high rate by the spring of last year was 2.5%. And it was going to come back down under 2% by the end of December of 2021. Instead, it shot up to 7.5% as well. So they've waited too long. Look, we're recording this in February. The Fed is still buying bonds in February. They are still easing. So they've been way, way too late in this. Maybe if they had started the taper earlier, ended the taper earlier, maybe had one or two rate hikes in place now, they would have actually changed the outlook for the bond market. But they are operating so late in this and they are under so much political pressure. Yeah, they're going to have to raise rates. And as I like to say, at this point, the Fed has only got trade-offs. They don't have a policy that's going to make everybody happy. Somebody's going to have to be upset here. They can either raise rates too much, risk inverting the yield curve, risk growth as well too, risk the stock market because they're fighting inflation. Or the Fed can say, no, we can't do that much rate hikes. We can't be that aggressive because we would risk growth, and then let inflation run. Because one of the other things is, let's say the Fed says that, all right, look, we'll raise rates a couple of times, but we really can't get aggressive in dealing with this inflation thing and raising rates too much. It's too levered economy. We'll put the stock market at risk. We could wind up having a reverse wealth effect. Go read the left-wing publications, Mother Jones, Axios, and stuff. What are the economists in those saying? Look, if the Fed can't get inflation under control, let's just bring back price controls. Let's just bring back wage and price controls. Yeah, they didn't work in the 70s, but they're desperate right now. The day we're speaking, the Washington Post has a story. The Democrats are the ones that love taxes, want to see fossil fuels usage reduced to save the planet. They're getting ready to cut the gasoline tax for the rest of this year because they're so panicked about what's going to happen in December as well too. So if the Fed doesn't get this under control, there will be, I think, talk about price controls before the end of the year. I think the Fed also knows this, and this is another reason why the Jay is saying, don't go there with those price controls. Let me handle this. I'll move 50 in March, and I'll just keep hiking every meeting until we slow the economy enough to bring down inflation. So as I'm trying to say here, there's only trade-offs. Is who gets screwed here? You screw the people that are upset about inflation. Why is inflation the number one issue in the country? According to the Federal Reserve's Survey of Consumer Finances, 40% of the American public has less than $1,000 of savings, and they rent. Every day they see prices going up, and they see their paycheck buying less and less. According to the latest CPI number, goods, which is about 30% of CPI, was up 18% year over year. Stuff was up 18%. 70% of CPI services, and they're up about 4.5% or 5%, which is still unacceptable, which is how you wind up with an average of 7.5% or thereabouts. So they're really seeing every time they go to the store, stuff is going up. Food prices are going up. Why do you think the president is screaming about big beef, trying to manipulate the price of hamburgers? And of course, gasoline prices again hit $3.50 a gallon nationwide, which is another 8-year high the day we're recording. So you're seeing those are the people that are tremendously upset. 40% of the country that doesn't own assets. I don't have a stock portfolio or own a house to watch them zoom up in price. Yeah, okay, I'm paying more at the grocery store, but who cares? Look at what my spiders did, my S&P ETF, or look at what the price of my home is right now, like the other part of the people are. So the Fed's got a choice. Do they help those 40% or they help the 10% that own equities? And that's where like I said, there's no policy that makes both of them happy. That ship sailed long ago. I think they're going to lean towards the 40%. And that's why I think that there's going to be a rude awakening in financial markets that they're not the priority anymore.
Let's come back to this question of whether inflation is transitory or secular, because, I've been in the secular camp, and frankly, I'm no expert on this. A lot of people I look up to who are much more expert than me are more in the transitory camp, as Alex Gorevich was last week. But, all those guys in the transitory camp, if I'd asked them 6 months ago, what do you think of the possibilities that we're going to get a January print at 7.48%? They would have laughed in my face and told me it was impossible. So I guess my question is, how do we draw a line in the sand and say, okay, if this happens, it's decided. We know that this is not transitory. It's actually quite a bit more than that. I mean, I'm hearing that inflation, according to all the experts who think it's transitory, is supposed to peak in February or March, sometime in the spring. So how long do you wait after that to see that the trend has stopped in order to conclude that that really happened? And if we continue to see inflation persist through the summer, say, to Labor Day, American Labor Day, the one that happens in the beginning of September, does that mean that the transitory group was wrong and the secular group was right, or is it still too early to tell? How do you decide? How do you know when it's right?
Well, I think the short answer is going to be it's going to take years for us to decide which side is going to be right. And let me start with this. Dan Trevillo was a Federal Reserve governor from 2008 to 2017. And I like to joke, the Federal Reserve governors you really want to listen to are the ones that recently leave, because most of the job of a Federal Reserve governor is you're handed talking points and go out there and read them like you mean it. But once you leave, you get to tell everybody what you really think. And Dan Trevillo went to the Brookings Institute in October of 2017 and gave a speech. And the speech was, the Federal Reserve really has no framework for inflation. We really don't understand why it goes up and why it goes down. There was an economist at the Federal Reserve, Jeremy Rudd, R-U-D-D. He put out a paper in September of last year. And the paper was essentially designed, why do we think there is such a thing as inflation expectations? And he basically argued the Fed always talks about inflation being well anchored. That's not a thing. It's kind of a made up thing that we don't even know what anchored inflation is or unanchored inflation is as well too. And that paper kind of slipped in under the wire. The Fed probably didn't want to publish it, but he'd been there for 20 years and figured out a way to get the paper out. So let me start with the premise. We don't know what causes inflation. I know you're going to get people, oh, yes, it's monetary, it's supply chain, it's this or that. Yeah, go ahead and correlate that over a long period of time, and the answer is zero. So this is what makes inflation so difficult. All we have are opinions about inflation. All we have are theories about inflation that eventually get, disproven. And the theory that we're disproving now in 2022 is is modern monetary theory. First it was monetarists that got disproven, then it was rational expectations that got disproven. Now modern monetary theorists, the Stephanie Keltons of the world, you're on the firing line now that you're going to be defrocked as the next theory as to what causes inflation. So let me start with that premise. We don't know what causes inflation. We think we do. We like to dismiss it as being this or that. And so therefore, the transitory crowd can do exactly what you said. There is no possible way we're going to see 7.5% inflation 6 months ago. And when we see it, they just plow straight ahead and say it's still transitory. And there is a non-zero chance they could be right, that inflation could peak and dramatically decelerate into the 2.5% range within a year. Now, I think the only way that's possible is if you had a dramatic deceleration of the economy too. You want to get 2% inflation back? Throw in over-tighten, have a policy mistake, have the economy go into recession. Guess what? You'll have 2% inflation within a year. But they think you can have it without a recession. So it is a difficult question to answer. And I think people need to understand that. If it wasn't a difficult question to answer, here's the theories. We all agree on it. This is what causes inflation. Then we wouldn't be having this debate. So I think we're going to continue to have this debate. But what I think has changed the dynamic that people have a hard time understanding is the political aspect of this debate. Panicky Democrats over what's going to happen in November, willing to cut the gas tax right now, telling the American public this guy named Jay is going to fix it. He's going to fix it right now, not voting on him, so that we've got like a veto over the Federal Reserve. Again, that wasn't their plan, but it's effectively become what they have right now is a veto over the Federal Reserve chairman and his new role and his role in a second term as well, too, putting tremendous pressure on the Federal Reserve to address 40% of the public doesn't own stocks, doesn't own a house, and is very, very upset about what they're seeing in terms of at the grocery store, at the mall, and at the gas pump. And even if you want to argue, well, the Fed can't print ships, the Fed can't print barrels of oil and stuff, the president has already told the public Jay's going to fix it. And Jay better start acting like he's going to fix it. And that means get aggressive with raising rates.
Let's take that notion of get aggressive with raising rates and talk about what it's really going to mean then for the stock market. Because if I summarize kind of the gist of what I'm getting from almost everybody, it goes something like this. Look, the Fed's going through this thing. They're gonna raise some rates for a while, but we've seen this movie before. We know what happens as you get to 20% or so down in the stock market, and the Fed changes its tune. The Fed kicks in, and they change their tune, and everybody just looks past it and says, "Don't worry, the Fed's got our back." I agree with you that I think there could be a lot of, not so much from the Fed itself, but political influence changing this as you see more and more people that have a very different view that favor that 40% as opposed to the 10%, really saying, we don't need to save the stock market. We need to take care of that 40%. And I think what we eventually get to, I'm surprised, Jim, that it sounds like you think MMT has somehow been discredited or disproven. It seems to me that the MMT crowd has still got the political ear, and I would anticipate that as things start to get bad, where you've got a real problem with inflation, the 40% is in real trouble, you do exactly what the President of the United States prescribed as the solution for inflation, which is pump more money into the economy. Now, that is obviously completely at odds with anything that anybody who understands inflation knows to be the right prescription. But that is what President Biden said, is we're going to pump so much money into the economy that inflation isn't going to matter. And I would imagine that the Fed can let inflation run hot while the MMT crowd says, look, let's support that 40% with a whole bunch of universal basic income, new transfer payments, new support, so that the people who are getting run over by inflation have extra money to pump into the economy, which of course just exacerbates the inflation and starts to get it to the point where it runs away. I'm certainly not suggesting what I'm describing is desirable or anything that I would advocate, but it seems to me that the political backdrop right now is for the MMT crowd to continue to have a lot of influence and for there to be a lot more stimulus. I think as we have to withdraw COVID stimulus, the politics are going to say, well, we got to replace it with some new kind of stimulus so that we can keep getting votes and handing out stimulus. The idea of withdrawing all the stimulus and letting the economy crash, that's not popular. We're not going to go there. Might change if there's a change in politics after the November elections. But for now, I'm not sure why you see this as the MMT crowd has been discredited. It sounds like you see it differently.
Yeah, so let me be clear on what I think they're beginning to be questioned on the road to being discredited. And as I said, every other theory before MMT as to how the economy works, what causes inflation, ultimately had been discredited at one point or another. Remember, everybody focused on money supply 40 years ago and money and monetarists. And then all of a sudden the monetarists stopped working as well, too, because ultimately inflation is a very, very difficult animal to understand. So yes, the questioning is begun with MMT. It started with a big New York Times Magazine article about 2 weeks ago talking about whether or not MMT is one, but it had an asterisk on it. And it was all about, explaining the inflation. And there's been an enormous debate. So the debate has begun. And I think it ultimately ends with them being just the next theory that goes down the drain, and they'll be replaced by another theory. It could be another pro-government type of theory that comes along as far as when inflation goes. The other problem with politics, let me go back to politics. Okay, so if the MMT crowd's argument is we need more stimulus in order to do what Europe has said. I mean, Italy and France have both come out in the last 6 months and said, I understand petrol prices are high and you can't afford petrol. It's already high enough as it is in Europe. So here, we're going to mail you money so you can afford gas, you can afford more petrol. Well, that just keeps the price high. The reason the price is high is because we need demand to slow. And if you're going to keep subsidizing demand, then the price is going to just stay up. Well, if MMT wants to say that, here's their two problems. Problem one, Joe Manchin of West Virginia, 50-50 Senate. Joe Manchin of West Virginia, who's a Democrat, has said, no way, he's not going to vote for any more stimulus. So you're not on the 49 senators. Kirsten Sinema of Arizona is probably not going to vote for it as well, too. Let me throw out a third one that a lot of people don't really focus on a lot. There's a Democrat senator, Ben Ray Lujan from New Mexico. He had a stroke 2 weeks ago, and he had surgery, and he's been in the hospital, and his staff is not releasing a medical update on his status. Now, he's still the senator from New Mexico. He's a Democrat. He's probably not going to be around for several weeks, if not months, to vote on anything because of his health considerations. You're down to 47 senators right now. You're going to have to find at least three Republicans, in order to vote for any kind of stimulus package. By the way, they voted for none of them last year. So there's going to be no stimulus. I don't care what the argument is about MMT. There's going to be no stimulus. And then if the Democrats lose the House and or the Senate in November, there's going to be no stimulus plans from this point forward. So what you're left with is, how do we, get the anger of the 40% away? And that is, we're going to have to aggressively tackle inflation. So yeah, you're right. MMT has not been discredited. I may have misspoke earlier, but what I am saying is the beginning of the questioning of them has begun. And I've seen this pattern for 40 years, starting with the monetarists in the early 1980s, and that they all kind of they all have their moment in the sun, and then they're all kind of defrocked, and then we move on to the next theory. And that's kind of where we are right now with MMT.
Okay, so let's finish talking through what happens with the stock market. You're saying that the stimulus really does get withdrawn, and it is, in fact, stays withdrawn. That sounds to me like it probably has to lead to a recession, and certainly the reaction of the stock market to the last FOMC is indicating a policy error and a move toward recession. But all the stock traders seem to just want to tell themselves, don't worry, we only got about 20% down, and then, it's Jay to the rescue. It's going to be fine. Are they going to be disappointed? Is the Fed put about to expire?
Yeah, so I think what you need to understand about what I'm saying, and I'm going to agree with Alex from last week a little bit on this as well, too. I think what you're going to see in financial markets is you're going to see relentlessly rising short rates. You're going to see the long interest rates trend sideways. So the 10-year note might get, it's over 2% as we talk right now. It hit 177 last March, so it's a grand total of 30 basis points higher from its peak last March. And you might get to 2.25. I think that's all you're really going to get out of long rates, as long as the Fed stays aggressive. Short rates will start to head higher. As the Fed stays aggressive, the yield curve will invert. And when a yield curve inverts, that's a market signal that something's broken. And, it may not be apparent the day that the yield curve inverts that something's broken. Now, that can be financial markets plunge. That could be an economy that goes in recession. It could be the plumbing of the financial system. The repo crisis of 2019 could be what you could see out of it. But something will have broken. Now, you transfer that to the equity market. Where is the equity market right now? Well, by most valuation measures, forward PEs, market cap to GDP, Shiller PE ratio, take your pick, price to book, price to cash flow, price to EBITDA, throw them all in the mix and say, in general, where is the state of the stock market? It's fully valued if you want to be charitable. It's overvalued if you want to probably call it what it is. And it's been that way for many years. And that's worked because we've been in a zero rate environment with no inflation and very accommodative central banks. Well, if you're now going to be in an inflationary environment, an inverted yield curve environment, and hostile central banks, and think that equity prices with full valuation are going to provide you a place to be, that's going to be a tough call, I think, is where it's going to be tough. Now, that doesn't necessarily mean that equity prices have to plunge. There is arguments to be made that inflation beneficiary stocks could be the place to be, like energy or industrials or basic materials. Yeah, but the only problem with that is that they make up like 5 or 6% of the S&P. But long duration assets like technology, healthcare, which have been, where the money has been made, they're really struggling the most and will continue to struggle from here on out. So, yeah, I think that, as far as equities go, everything's working against you. You've got inflation, you've got a flattening yield curve come, and maybe an inverted yield curve, and you've got a hostile Fed that's about to begin in March. Yeah, if you told me you had a PE of 8, I might say the stock market can handle that. But when you tell me that the forward PE is still over 20, which is a very rich number, which is still high even relative to the 2000 peak as well in the market, that's where the valuations are. That only works to buy a 20 PE if you've got zero rates, no inflation, and everybody's pulling for the stock market and the Federal Reserve's priority is growth. Well, it's not growth anymore. You've got everything working against it. So I think it's going to be a very tough haul. Yeah, you might find some places to hide in inflation beneficiary stocks, energy stocks, industrials, that kind of stuff, basic materials, but they're a very small percentage of the overall stock market.
Jim, I want to shift gears completely because we've only got a few minutes left, and I want to touch on a subject I know I can talk to you about, and frankly, not many other people, because when I talk about decentralized finance and how I see the biggest thing that's ever happened to the finance industry, bigger than the internet, bigger than the personal computer, the biggest thing ever is going to be the tokenization, not just of currencies, but of all financial assets I think it'll probably take 20 to 30 years to fully play out. When I try to have this conversation with almost everybody in finance and say, let's really talk about tokenized assets and let's talk about where this trend is headed and what it ultimately means long term. And particularly, I have a lot of ideas in my book. I wrote a whole chapter about my vision of a digital sovereign bond market, which fundamentally changes the playing field in terms of the ability of smaller countries to finance their borrowing needs and so forth, and how it could really change the playing field for equitability of humanity. And I think this is a very fascinating topic. And every time I try to have it with anybody, they say, oh, yeah, interesting topic. Do you think Bitcoin's putting in a double bottom here at, 30 whatever thousand? It's like, dude, why are you bothering to look at a Bitcoin chart? Why is that even an interesting topic? I don't get it. It seems like nobody wants to look at the long picture here. I know you're one of the few people I know who does, and I'm going to suggest to you that as I've looked at the entire financial landscape and I look at the technology that's coming in tokenization, I think fixed income is the low-hanging fruit. I think that bonds are basically the most antiquated part of the financial system. They're the ripest thing to completely reinvent and replace with something much better. We don't have time here to get into all the details of why I think that. But what do you think? And as a fixed income guy, what do you see on the horizon? How do you interpret this whole DeFi trend?
Oh, man. I mean, we could do a whole hour on just this one subject right now. But I agree with you. A couple of thoughts. Let me start with one thing you threw out there, first of all. In the crypto space, there's a term that they use called degen. And degen is short for degenerate gambler. And it seems like all the traditional financial people are a bunch of degens. They just want to buy a token and watch number go up. And I've gone the other way. I try to look at the protocols and I try to understand how they work. I've tried staking. I've tried lending. I've put my tokens in a liquidity pool. I've traded them on automatic market makers. I mean, I'm trying to understand this space for how it's designed and what its purpose is, instead of just opening a Coinbase account, buy some BTC, and just pine for number go up. And that seems to be where the problem is with a lot of people. So they think it's just magic money or magic beans that they're trying to trade up and down. But if you go the next step and you understand what decentralization means, what a decentralized autonomous organization, a DAO, means, what it means to stake a coin, either in a liquidity pool or borrow against it or lend against it in a borrowing or lending protocol, buy insurance against it, and do all of this other stuff, what comes into focus is, you're absolutely right, a whole new financial system comes into focus. A whole new capital stack comes into focus. What is the capital stack now at the high end is senior debt, then junior debt, and then at the low end is equities as well as, and you're starting to change the whole idea of the capital stack. And I agree with you. You could start changing that capital stack at the fixed income end of it, that the idea of a token and that issuing a token and trading a token could be a replacement for fixed income. A lot of people aren't there yet. And part of the reason that they're not there yet is this gets very uncomfortable for a lot of people in traditional finance. What do you mean we're going to replace my job? We're going to replace what I do. We're going to replace my company as well. And so they get very nervous about that kind of talk, and that comes up being very dismissive regulators will never allow it. Why won't regulators allow it? And then they'll mumble something about investor protection. And I always like to say, you mean incumbent protection is what you're hoping that the regulators are going to wind up doing. So I would argue to you, yes, that what you're seeing is a whole new way of doing things. And it's almost flipped on its head, because what's interesting that's happened because of all of the rules we have, you've got these protocols that allow you to borrow and lend and stake your coins and trade your coins on automatic market makers and stuff. And that's open to you and me and everybody else. Anybody can go open an account, move your money to an unregulated wallet like a Dharma or MetaMask, and you can start, connecting with these protocols and doing all this stuff. But institutional investors can't. So some of these protocols are creating different levels, which are institutional levels with know your customer and anti-money laundering rules, and saying, okay, institutional investor, you could come in here and we're going to have a special institutional investor place for you. You're fundamentally at a disadvantage. So we've kind of flipped the script. You're better off in this world, this crypto world, being a retail investor. You've got access to everything. You've got the edge. If you're an institutional investor, you're hamstrung with all these rules. You're put at a disadvantage. That's kind of the opposite of what the current financial system is right now. So, yeah, I agree that this whole world is going to open up something. And I agree with what you said many years down the road. There is no immediate change coming right now. But over the next generation, in a generation, what we consider to be investments and how we invest and how we think about the way that we raise money and we allocate money is going to be completely different than it is now. And that also leads to another issue. When I say that, oh yeah, it's going to take a generation. a bunch of people over the age of 55 or 60. That's my age group as well too. Okay, good. Then I don't have to do anything. I just have to sit here and just continue on, because in 5 or 10 years or so, I'll just retire. And that poor guy that works for me down over there, he's 38. He's the guy that's got to figure it out. I don't have to figure it out. And the only thing I've always said to them is be careful on that, because this stuff tends to sneak up on you a lot faster than you think. But yeah, Erik, I wish we had a whole hour to talk about this, because it is a very fascinating subject.
Well, Jim, the single most compelling thing that you just said, at least to my ear, was that you could do a whole hour on this, because frankly, I would love to pitch to you, this is in my book, the reasons that I think it's not about crypto or tokenization of fixed income assets. It's about re-engineering the 500-year-old fractional reserve banking system. If you look at the securitization of mortgages we've been doing since the 80s, it proves that FRS is not the only way to orchestrate credit. And I contend there's much better ways to design consumer credit, commercial credit, everything else. You don't need fractionation of assets. You don't have to have this crazy broken system that we've had for 500 years. There is a better way. And every time I try to talk to anybody about it, they want to talk about the price of Bitcoin. So I'm going to put this out to our listeners as a poll. Let us know on...
I was just going to say, I 100% agree with you. Just real quick, the fractional reserve system and the idea of a corporation with equity in a corporation, that was invented in the Renaissance 300 or 400 years ago. And now that we're moving into the digital age, they're not really good models for the digital age. And what we're talking about is a whole new financial system to meet the needs of the digital age.
And here's my contention. When you talked about those 55 to 60-year-old guys, look, the crypto kids know way more than us about cryptocurrency and digital assets and so forth. When it comes to why the fractional reserve banking system is inherently flawed and needs to be better, it's us old guys who have a lot of insight. And I think a lot of us are missing the opportunity to learn all about DeFi and tokenized assets and start putting our fundamental knowledge of how the financial system works, which most of the crypto kids have no idea about, to work and say, how do we apply this new technology in order to make the system much better? Nobody wants to talk about it. So I'm going to put it out to our listeners as a poll. Let us know on Twitter or send us an email at requests@MacroVoices. Tell us if you want us to get Jim back to do an hour just on that subject, a little bit outside of our usual charter of macro, but I think it's an absolutely fascinating topic. We're going to have to leave it there in the interest of time, but first, Jim, just give us a real quick rundown. What do you do at Bianco Research, and how can people follow your work?
We are a subscription service for Macro Research. You could follow me at Bianco Research on Twitter. That's probably the place I'm most active in social media. Maybe LinkedIn under my name, Jim Bianco, or visit our website, biancoresearch.com.
Patrick Ceresna and I will be back as Macro Voices continues right after this message from our sponsor. Feeling like you've hit a wall with your investment strategy? Or maybe you've been burned by the stock market too many times since the start of the pandemic. What if I told you that you could invest in a resilient alternative asset class that the elite have been quietly putting their money into for centuries? I'm talking about blue chip works of art. Artwork that's outpaced the S&P 500 from 1995 through 2020. And while it used to be inaccessible to the everyday investor, that's no longer the case. Masterworks is the billion-dollar startup securitizing the once exclusive art market, allowing you to finally add iconic paintings from masters like Banksy, Picasso, and Basquiat to your portfolio at a fraction of the cost. And right now, Masterworks is giving my listeners priority access for their newest offerings. Start putting your money to work at masterworks.art/macrovoices. Again, that's masterworks.art/macrovoices. See important disclaimers at masterworks.io/disclaimer.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have Jim back onto the show. It was great to get his updates on what's going on in the Fed and so on. What did you take away from the interview?
Well, to be perfectly honest, Patrick, what I found most intriguing was Jim's reaction when he said he wanted to talk for an hour about decentralized finance and what it could mean to the future of fixed income markets. Listeners, please do let us know whether or not you want that interview. And if you do, we'll try to get it booked. It's a little bit outside of our usual macro charter, but I think it's a fascinating topic. I want to move on, though, to our post-game chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads just above Jim Bianco's picture. Patrick, the chart deck is titled, Is There More Downside to the Markets? First three slides look to be the major equity indices. What's going on here?
Right. So for at least this week, I wanted to reference that 50-day and the 200-day exponential moving averages. And just as a reference point to where we are in the markets, one of the things that we've seen during the bull phase was that every time the market would dip down toward the moving average, just consider it sort of like a midpoint of an advance, it was bought on dip very aggressively and quickly, and it spurred the next legs of the market rallies higher. We have seen a dynamic shift in the last 2 months in the way the equity markets are behaving. They have become very distributive, and no rallies are sticking, and all rallies are failing. And these, while this in itself doesn't guarantee another leg lower, it does show that the price action is generally distributive, very weak, and therefore it does make the market continue to be quite vulnerable. It's interesting that the S&P 500 is consolidating right along some fib zones, which conveniently is where that 200-day exponential moving average is. Traditionally, some of the bigger market corrections, think of like the Christmas massacre of 2018, when the markets got below those 200-day moving averages is when the selling really accelerated. And so while I'm not trying to predict that this drop is imminent, and to highlight the vulnerability of the market at this stage, because if anything spurs a sell-off that gets under 4,400 on the S&P, it could really start to feed on itself and create a mini liquidity event that could have us testing even 4,000 on the downside within a week or two. Let's see whether the bulls can put it together. Also just highlighting on the NASDAQ and the Russell, both of them are not only below those moving averages, but continue to be rather weak on a relative basis. And so this is just a very weak market. The breadth continues to be very poor. And overall, I think it's important to be very cautious in this market environment.
Well, Patrick, I'll be the first to admit that I don't know what to make of this market environment. As I think through everything I know from the old normal, how markets used to work when economic fundamentals were the primary determinant of market direction, I would say the market is shockingly still overvalued and overdue for a crash, and I wouldn't be worried about down to 4,000. I'd be thinking about down to 2,500. But, every time I've had that kind of view in the last 10 years, I've been wrong. And it just hasn't worked out that way. So I don't want to make a directional call. I would say there's lots of room, though, if things get going for a bear market. We've got a whole generation of professionals who don't know or haven't ever experienced a bear market, and I think it could get really interesting. Let's move on to gold futures on page 5. What's happening here?
Well, I mean, you summarize gold very well in the market wrap in the sense that it's a very bullish breakout. But what I really like to do is just zoom right out. This is a weekly chart, and so that's a 50-week moving average that the market was hovering on. The key was we had a very strong gold bull market from 2019 to 2020. And after an extraordinary run that saw gold almost double in that time frame, we've spent more or less well over a year just backfilling and consolidating the move, whether you want to call that some sort of a triangle formation or a wedge. Bottom line is that the market has been winding up and unwinding the overbought state that it was in. With this breakout, if the bulls, and the key was exactly like you're saying, if the bulls can actually hold this breakout, this could potentially be the beginning of the first leg of a trend move that may come in play. And And when you really look at the scope of the length and duration of the average move in gold over the last couple of years when it breaks out, this is really just the beginning. And one of the things I'm going to be watching here is whether we see the characteristics of every time there's a sell-off, whether the bulls keep buying dips, whether the price continues to be well defended, are all the types of characteristics that will start to exhibit that a potential new trend move is underway.
Well, Patrick, I've had a question for you I've been thinking about all week, which is if we zoom out even farther, if you imagine seeing all the way back to 2011 on this chart, the price goes back up to right about where we are now in the mid-1900s. It really looks to me like the price action from the summer of 2011 through the summer of 2020 could be the cup in a cup and handle formation. The thing is, I can't decide if what's happened since the summer of 2020 really looks like a handle. It seems like it's awfully stretched out to be a handle. What do you think? Could this be a cup and handle? And if so, what would the implications be?
Well, a cup and handle formation is typically seen after an extended bottoming formation. To me, while the pattern does exhibit that, where you have a long rounding basing formation, that pattern would appear, I think that it was really just a very big and extended correction, a bear market correction of a very overextended gold market. Bottom line, though, is that overall gold has been behaving very well if you zoom out on weekly and monthly charts. The problem that gold has had is in the last year, while everything else was making money, gold wasn't. And therefore, the sentiment toward the space just wasn't strong. But after this type of a correction, inevitably, every market has a cycle, and will be interesting if this is the beginning of a new one for gold.
Let's move on to fixed income markets. The next three slides, we're looking at Treasury bond yields, investment grade, and high yield.
Right. So what I wanted to just simply highlight is obviously the jump in yields has been driving the entire credit market, and so as we have the 2% level being tested on the 10-year, and obviously 5 and 2 years have been just ripping on the upside. This has stressed all of the markets. Now, one of the things that we highlighted weeks ago was the investment grade corporate bond market using the LQD ETF, but just highlighting simply how weak the investment grade corporate bond market continues to be. Again, this is an incredibly bearish and ugly looking chart, and the selling seems relentless and doesn't want to quit. But what's interesting is over the last month was the first time in a while that we've started to see the credit spreads start to wobble. Like the first part of the drop in junk bonds and in investment grade bonds was really just correlation to treasury yields. As the entire interest rate market was moving, they were adjusting and going down. But we're now finally seeing, a 1-year spike highs on both high yield corporate bond credit spreads as well as investment grade credit spreads, which means that the stock market is starting to get a little bit nervous and pricing in some of that risk premium. It'll be really interesting to see if this trend continues. And certainly you have to think that if we see corporate bonds start to really get hammered, that the stock market is going to start carrying at some point. And that certainly could be a catalyst for further weakness in the stock market if this trend continues.
Listeners, if you enjoy Patrick's chart decks, be sure to check out a free trial of Patrick's service, Big Picture Trading. You can get these chart decks every single day of the week. Information's on page 9 or at bigpicturetrading.com. We're going to leave it there for this week's show. This episode is brought to you by Abex Technologies, pioneering the design of smarter markets that better serve the needs of both market participants and society as a whole. And by Masterworks, the billion-dollar alternative investment platform that lets you invest in art by legends like Warhol and Picasso for a fraction of the cost. Patrick, tell them what's in this week's Research Roundup.
This week, you're going to find the transcript for today's interview, as well as a link to the chart book that we just discussed here in the postgame. There's also a number of links to the articles that we found interesting, so you'll find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup roundup at MacroVoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend, that's Erik spelt with a K, and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.